Okay, good afternoon and welcome back everyone to our futures education session. Today, my name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay, and I have a very special guest, Frank Kaberna from the Small Exchange, to talk about a corner of the market that we don't talk about too much, which is statistics and math and how you can actually use it to find trading opportunities. So first, I want to say a huge welcome to Frank for joining us here this afternoon.
Tony, thanks so much for having me, my friend. Yeah, I'm glad to be here, glad to speak to a little bit of this opportunity that you and I feel like we've been on the cusp of bringing to a wider public in the last, several months here, my friend. And so always happy to talk stats, talk data, and how it can apply to getting into the lesser known derivative of futures here. I know it's options play, but quickly becoming options and futures play. So hopefully we'll have some fun playing with both here today, my friend.
That's exactly right. And while this corner of the market of using statistics to find trading opportunities may not be a corner that you've explored and may sound complicated, we're going to try to bring this down to a level that everyone can understand and an actual trading strategy that you can implement with your account. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss in today's examples. So we'll start off by talking a little bit about kind of the background of statistical trading strategies and where it kind of comes from, within institutions in Wall Street and how it applies, as a retail trader, how you can potentially use it in your trading accounts. And we're going to talk about a few concepts that are important to understand before you deploy these types of strategies, which are mean reverting assets, what those are, because those are the types of products that you typically would use a strategy like this for, and a concept called standard deviation that you have to understand before you can trade these. So as long as you understand those two concepts, which we will break down between Frank and I to help you better understand, then we'll talk about, why futures, as a contract, as a product, in my opinion, is best suited for this specific type of strategy. And then we'll go through some live examples, some of our trading tips, and open this up for Q&A here at the very end. But before we get started, I do want to give Frank a chance to talk a little bit about his background and his role here at the Small Exchange, because Frank, it's actually something that's new to me, is that, I found out through this that you actually have a math degree, which makes a lot of sense as to, why we're here to talk about statistics. But if you could talk a little bit about your background in terms of how did you go from math to trading to now sitting in your seat here at the Small Exchange?
Yeah, absolutely. So I graduated from University of Michigan studying math there, and the question then becomes, what the hell do you do with such a degree? You can go teach math, dive into the deep world of math theory, or try to put it to some use here, try to make some money. And that's what I did, man. I applied my math degree to one of the biggest hubs of mathematics and statistics, one of the biggest practical hubs, that is, I guess, of the Midwest, which is the Chicago Board of Trade. And so that was fun for about 12 months of trading Asia and Europe there. Overnight session was, I am facetious, it wasn't so much fun. The trading part was great, though. And while I learned a lot there, I learned a lot about applying stats and math and everything else to markets to make some money. Tony, to be honest, wasn't super into the idea of like, oh man, I want to sit here and just like turn on the money machine and churn things back and forth. I was trading primarily, cash treasuries against treasury futures, against Eurodollar futures, all these different products, big spreadsheets looking at arbitrage and everything else. What I thought was more interesting, Tony, was like, let's lend some of these ideas out to more accessible products for everybody. Apply some of these math and statistics to the growing group of people just trying to make money on their own, retail traders, if you will. And that's how I landed over at Tasty Trade, writing mainly statistically based content for that network. That was another, very, very positive experience in terms of learning so much there, and how I can take kind of all this theory from Michigan, and then all of this kind of like deep trading analysis from the Board of Trade, and then walk it all the way back to the most accessible, practical version of this, which is like trading Apple stock, trading, easy to access futures and stock and options markets for everybody out there. And then after a couple of years at Tasty Trade, Tony, I landed here at the small exchange, helping to create product and create, content and education for everybody out there. So what's really nice is the place that I'm at currently here, I can help to kind of curate an experience for everybody, from creating a very simple, small product on interest rates or on commodities or equities or everything else, and then also lend my experiences and all the data that I've chopped up over the years to helping people trade those things around, manage their finances, hedge different things, speculate, and make some money for themselves. And that's where we're at here today, with applying all of that data, all of that stats to some of the small products.
Well, thank you so much for sharing, your background, because I think you are the right person to walk us through these types of strategies, and that's exactly what we're going to do here today. Now, before we get started, I just want to test the waters here. I do want to launch a poll and get a sense for how many of you have traded a futures contract before. If you don't mind answering the question here on your screen, this will give us an idea as far as the audience here. And while you guys are answering, and just to let you know, as we're going through the education session here today, if you have any questions regarding what Frank and I are speaking on, you can type your questions into the Q&A window. We have staff from both the small exchange and OptionsPlay available to try to answer your questions during the sessions live, and then Frank and I will pick through the questions afterwards to answer any questions that may be remaining. So you can ask questions live as we go along in the Q&A section, and we will answer your questions. So at the bottom of your window, there's both a Q&A window and a chat window. Bring up your Q&A window if you have any questions as we go along. And this is actually quite an interesting poll here. We have over almost 80% of people have answered the question here already, and 46% of attendees here have traded a futures contract before. 53% of you say that you have not. So almost half, 50-50 here in terms of the room, okay? So many of you seemingly have traded a futures contract before. You'll be familiar with what we're going to talk about here today. Maybe not familiar with the specific products that we're going to be talking about. So hopefully you'll also learn something new. And then actually the bulk of the room here, 55% of you who have not traded a futures contract before, we're going to talk about why futures is a suitable product, or perhaps even a better product for trading the specific strategy that Frank and I will discuss during today's session. So let's jump right into it. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you find both intraday and longer term opportunities in the futures market with statistical analysis. Again, for those of you that have been following me for a while, you know that I'm heavily leveraging both technical analysis and fundamental analysis when it comes to equity options trades ideas that you see me put out here at OptionsPlay and on CNBC. Statistical analysis is something that, while is used in certain aspects of technical analysis, is not very commonly used as a pure rule for entry and exit, but that's exactly what we're going to discuss here today. And a very simple one, I'll add to that as well. So let's start off with just talking a little bit about the background of statistical trading, because, Frank, this is frankly something that is really traditionally used by both institutions, only by institutions and professionals, simply not as common as technical and fundamental analysis. And it comes down to just the degree of math that's typically required to trade these types of strategies. So, I think your math background suits this well, but tell us a little bit about kind of how the retail trader here who's watching this today, who doesn't have a math degree, who doesn't trade an institution or a hedge fund, can still leverage this for their trading.
Yeah, right off the bat, Tony, I can almost guarantee that everybody watching here today is going to be able to walk away with these concepts and be able to put them to use. I mean, it's a funny time whereby like you watch baseball or any sports and the amount of advanced stats that true heads of those sports get into are like pretty out there math that I'm guessing no one, went to university or whatever for. The stuff that we're going to crunch here today is along the same lines, maybe even a little bit simpler than, like I say, especially some of those baseball metrics, man, that stuff is wild. And so I can almost guarantee you're going to come away with these stats here today, know how to put them to use, because at the end of the day, they conceptually make sense. That's a nice thing about math, is it really is just like a grouping of numbers and proofs and data sets that at the end of the day can kind of just confirm what you already might have been thinking or seeing in your charts and everywhere else. And so I'm super confident that people are going to be able to add this to their bag here today. And it really will be a nice marriage to the other stuff that you see out there, which is great. Like so-and-so thinks that, crude oil is going to go higher because of this macro point, this supply point, or what have you. That stuff's all great. But adding this statistical background that isn't opinion-based, that purely is data-driven, can really help with making a lot of decisions on the front end. Should I get in or stay away from this thing? And also on the back end managing as well. I found that that's been a huge piece to helping people here, is using these stats to like, when should I get out for a profit or for a loss? And so we're going to cover all of it, man. But I do have to guarantee here on the front end, I can't guarantee much because our compliance will get super mad. But what I can guarantee is that like this stuff, it depends on a lot of high level stats and high level number crunching, but the takeaways will be pretty simple and very applicable as soon as hopefully tomorrow afternoon, man.
Yeah. So basically, as the institutions and traders like Frank have done the homework, they've done the work, and what you get to really see is the end result of all of that math and an actual strategy that you can take home after today's session. So before we actually dive into the strategy itself, I think it's important to define what type of products this strategy is useful for, right? We talk about fundamentals. Fundamentals are good for equities. They're good for, if you understand the fundamentals of supply and demand for commodities, you can use them to trade commodities. Technical analysis is one of the few, I would say, sources of analysis that you can use widely across almost all asset classes. But statistical analysis is not necessarily suitable for every single product out there. So this is really where we have to introduce the concept of a mean reverting asset. These are specific asset classes that these types of strategies work best for. So Frank, do you mind just talking a little bit about, what's a mean reverting strategy and kind of what type of products, are mean reverting?
Yeah, absolutely. And I don't want to oversimplify this because a lot of numbers and data did go into this strategy in the presentation here today. But I always back this out to this idea of like, you look at here, you're looking at the 30-year US Treasury bond rate. We also have the 10-year note rate and the 2-year note rate as well. Prime product for an idea like mean reversion. Now, why is that? Well, look at right now, 30-year rates are at about 2.5%. Look at 5 years ago, around the same levels, 10 years ago, 20 years ago. This is an asset class that doesn't necessarily drift in one direction or the other. Commodities, another prime asset class for this type of conversation. Of course, there are always events. Every single year, there's going to be an event that's like, man, I see gold going up to 3,000, or, oh, I see gold falling below 1,000. There's always going to be extremes. That's where the opportunity really kicks in. But you look at gold prices a decade ago, 2 decades ago, they're in the same neighborhood, man. You can't say the same for the S&P 500, obviously. When I started trading out, that was an index that was $2,000. When it got distinctly above 2,200, I remember that being a big deal. When it got to 3,000, a big deal. 4,000, it was like, all right, man, like we're not even trying to play this mean reversion game here due to, a bunch of different factors. But at the end of the day, the concept is essentially there's a market here, be it interest rates, be it gold, crude oil, one that actually is right now, as we speak, in this breakout phase of, are we in a new normal of crude, or are we going to get back to a more normal 70-80 crude level? I would bet on the latter there, because the idea is mean reversion, and a lot of options traders out there, Tony, I'm sure yourself included, know this concept, whether you know it or not, and apply it to options selling when VIX is high. Those option prices, it might not be next week, it might not be next month, but those option prices are going to come down. I'm selling that high implied volatility. I'm selling strangles, iron condors, what have you. And maybe I need to roll them out in time a little bit, but I can bank on the fact that since implied volatility was measured starting back in the 90s, early aughts, that market has come back to a mean. You've got the same concept here applied to interest rates, gold, crude oil, and everything else, and now trading futures based off of that concept. And that works in a long-term fashion, also in a short-term fashion. I like that starting here, the longer term is really the best place to start, because you can, it's hard to argue against, right? Like you look at every single time. I mean, last year, the 2-year interest rate is as close to 0% as it's ever been. And everybody is condemning that thing to negative, Tony. And as they're condemning it to negative, I'm sitting here with you and other people going, man, like, it doesn't feel good to be holding 2-year rates right now, but I'm inventorying 2-year rates because I would guess they're going to get back to normal. Now that market is ripped through its average price to the, just an example here of, like, when given the opportunity to bet against something that is a significant outlier in a mean reverting asset class like interest rates or gold or crude oil or what have you, I'm usually going to go against that outlier. And it's hard to argue with history. This is 10 years of data that you're showing in 30-year bond rates.
Yeah, that's exactly right. And just to clarify again, when we refer to mean reverting assets, these are assets that don't trend over time. They tend to trade around an average price over not just a few days, over a few years, sometimes decades. And what you're looking for is when the asset trades in to an extreme level away from that average, you're looking for it to revert back to the average. So when we refer to the mean is just another word, a mathematical word for average. And we're looking for extremes away from that average to get back to the average. Does that make sense, everyone? Please type 1 into the chat window if that concept makes sense to you. I just want to get a pulse here on the room before we move on. Okay, great, Frank. We see a lot of 1. So that, I think, is a good time for us to transition to the second point, which is a standard deviation. So we've talked about an average, and we talked about outliers or extremes away from that average. So let's talk a little bit about standard deviations. And most of you that are options traders have at least heard of the term, if not are familiar with the term. Let's talk a little bit about how standard deviation from a math perspective helps us define what that average is and where the outliers really sit.
Yeah, absolutely here. I mean, so a standard deviation, first of all, if you've got Microsoft Excel, I mean, if you've got Google, you could probably do it using the Google search bar. It's essentially a function, Tony, that takes a data set, like as small as 3 or 4 data points, or as big as some of the data sets that I'll look at will have thousands of data points here. It takes that set and it spits out a number that lets you know, okay, this is where most of your data lives inside of. And so for the sake of today's conversations, a good example is looking at daily net changes and how you might apply a standard deviation to day trading, right? So like I might take a market like crude oil, for instance, and look at the last several months of daily net changes. Maybe 3 months ago, it was at $80. The next day it was at 81. Okay, that's a net change of 1. The next day it was at 83. That's a net change of 2. I take that whole data set there, Tony, I run a standard deviation on it, and it lets me know, okay, this is where plus or minus the majority of your data sits inside. It spits out essentially a normal range for that data set there. Now, where things get interesting from a trader's perspective is when a market is outside of that normal range. Because if I give you, all right, here's a bunch of data on crude oil. Here is the range, plus or minus $1 or $2. That's where it normally is. And the market is up or down 50 cents. You say to yourself, all right, there's not really much for me to do. Opportunity usually sits in extremes. And so this is a great gauge, Tony, for day trading and everything else. But also it can be applied to that last chart that you showed, the 30-year note rate, because the idea goes like, yes, I can understand that this market will mean revert. And I can know that the mean is maybe, let's call it 3% in the 30-year treasury bond yield. But how do I know when to buy or sell? Is 3.5% expensive? Is 4% expensive? Is 5% expensive? When are we outside of that range? When should I be getting in? That's what the standard deviation lets you know on a short-term basis or a long-term basis. Essentially, yes, 68% of the time, 68% of your data lives in this box. I don't really care about buying or selling when I'm inside the normal range. When I'm outside, man, that's when I think there's opportunity for us to come back into that normal range. Is that making some sense there?
Yeah, so exactly. At least it makes sense to me, and we'll check the audience to make sure that they understand here as well. But the idea is that we're looking at the daily changes, if you will, of an asset, and if today it's within that normal range, there's no opportunities. When you find that the asset has moved beyond that range, that's when you can then effectively have a trading opportunity for that reversion or back to the long-term average. So the standard deviation really gives you, the average, and it gives you the range with around that average that the asset tends to trade in 68% of the time. So if it trades outside of that average, you have a statistical edge that it will revert back to that mean. And that's at the core this particular strategy. Does that make sense to everyone? Please type 2 into the chat window if that makes sense to you. And up till now, we've only talked theory. We haven't talked any real numbers yet. And I think this is really where, once we understand the theory, let's talk about some real numbers to hopefully help solidify this concept. And I see a bunch of 2s here on the screens. But before we jump into that, I do want to talk a little bit about, now that we understand the concept, we also have to understand, how do we actually trade this, right? So we understand that if it's above the average, we look for a mean reversion, but let's talk through the mechanics of trading, because you're looking for moves on either side outside of that range, right? It could be above the range, it could be below that range, which means that you have to be able to trade both opportunities in order to take advantage of this type of strategy. And that's really where I think, there's 2 ways to potentially do it. You can do it through futures, you can do it through equities or equity options, if you will. But there's, in my opinion, some distinct advantages to using futures products to trade this particular strategy. For me, it's really around flexibility and efficiency versus the fact that when you're using equities, they tend to be quite capital intensive, if you will, to execute the strategy. So in both product classes, futures and equities, you generally you have access to these mean reverting assets that we're talking about. Commodities, whether you're using an ETF to trade gold, silver, oil, you have access to all of them. You have them in the futures market. So you have access to both, I would say, fairly equally. Some a little bit better than the others, but largely you have access to both products from both futures and equities. But I think where it really kind of differs is the amount of capital that's required to take a position and how easy it is to take both a long and a short position. That's where it's distinctly different between futures and ETFs. So Frank, if you don't mind just sharing a little bit about kind of the differences between futures and ETFs from that perspective.
Yeah, absolutely. I mean, this is a case where the theoretical part of it, it holds no bearing in this comparison here, where it's like, oh man, if I'm not trading the futures, then crude oil USO might not mean revert. No, that's not going to really hold any bearing in whether you trade futures or equities, or like you say, options as well, to get your mean reversion going here. Why use futures? Well, you nailed it. First of all, it's easier to buy and sell any asset using futures for a multitude of reasons. It's going to be usually cheaper as well, given the efficiency of futures margining rates. And so the last thing I would say also is when you're looking at day trading and applying statistics and mean reversion to, an opportunity that we look at here today on the same point as crude oil, which is like crude oil moves on average, let's say $3 to $4 in this recent climate, and the market, boom, right around 1 o'clock today, Central Time, 2 o'clock Eastern, crude oil falls $5, $6, $7 at its lowest. I just want to pick that thing up and sell it back. Well, there are pattern day trading rules that also apply here, and I don't want to be holding crude, man, overnight. And so a lot of reasons to be trading futures here. And a funny thing actually is that futures, their margining system, Tony, takes into account one of the biggest cruxes of spitting out that more efficient buying power is the standard deviation. I mean, the people who are sending you a buying power for your futures trades are giving you that efficient rate because they're crunching the numbers on their end, throwing a standard deviation around it and saying, okay, we see that on a daily basis, this market moves $200, $300. Our margin is going to be around that level, as opposed to equities where it's like, no matter if it is moving with 100% IV or a 10% IV, we're going to margin you at 50% or 100% of that underlying market. Same goes options on equities, better, but still stuck around like 20 to 25%, depending on the market when you go to sell a call or a put in there. So able to get long and short a lot easier in there, and the margin just a lot lower because they are modeling your buying power off of how much that market actually moves.
Right. So like I said, you can achieve this through equities. You can achieve it through equity options, but it's just simpler and easier through futures contracts. So regardless of whether you trade futures or not, you'll be able to learn something today and be able to trade them in your equities account. But if you are thinking about trading futures, or if you are trading futures, you are going to get that capital efficiency, no pattern day trading rule, potential tax benefits if you're in a non-taxable account. So a lot of benefits potentially to trading futures. So with that, let's get back to the trading strategy, because ultimately that's what I think everyone here is here to view. I'm going to start off by going through a generic example. We're not going to apply to a real trade just yet, because I want to make sure everyone understands the math behind this, and then we'll apply it to a real asset. So first, let's just assume you have a mean reverting asset. Doesn't matter what it is, call it commodity XYZ. And currently this commodity XYZ has a price of $100. And what we've done is we've done some statistical analysis. We've taken the daily changes of this particular asset, and we said that the standard deviation for this particular asset is $5, meaning on the 68% of the time, the stock or the asset will move within a $5 range intraday. That's what we've defined so far. And what we're trying to do here is understand, when is there an opportunity to actually trade this particular asset? So Frank, if you don't mind, walk us through these numbers. $100 asset, $5 standard deviation. When do we actually have a trading opportunity in this particular asset?
Super easy setup here. I love that we're starting exactly where I would start, because this is, you've got your $100 market and your standard deviation. That's essentially all you need to be trading mean reversion to. Be applying this strategy. And all those numbers tell me, Tony, is all right, well, I've got my starting price at the start of the day. I've got my standard deviation. If the market breaks above 105, I'm getting short this market. If it breaks below 95, I'm getting long. And so your entry points are, like we say, outside of the norm. Your one standard deviation is plus or minus $5. You can also, the way I view this a lot of times in a given platform is just looking at the net change. You don't have to crunch these numbers for yourselves. It's pretty modern times we live in when it comes to digital technology, and they'll give you a net change in there. So yes, I can go and look at, okay, yesterday's close was 100. And so now I'm looking for 106 to sell, or 107 to sell, or 93. You could just look at the net change and be like, all right, market X has a standard deviation of plus or minus 5. If that net change is showing +6, I'm selling. If it's showing minus, 5.5, -7, whatever, then I'm buying. Very easy entry. But I love that you also nailed where's a realistic place that I can get out here for profit or for a loss if I'm day trading and I don't want to take this risk overnight. While this strategy theoretically does perform 68% of the time, that market coming back into that range, there are going to be, about 30% of these outcomes where the market moves outside of that normal range and stays out there. So you can either close at the end of the day or close if the market gets a half a standard deviation past you. This was the most classic setup for me at the board of trade, Tony, which was market is 100, standard deviation is 5. Let's say it moved down $6, so I buy the 94s. Well, I'm looking to now sell for a profit $2.50 higher, which is half of that standard deviation, or take a loss $2.50 lower. Very, very solid setup, and what I would say is kind of the greatest entry point when you are looking to apply this for the first time. And it makes a lot of sense too. A lot of those option traders out there who have looked at, oh, I'm selling a strangle for $2 and I'm looking to make $1 on it, 50%, or I'm looking to make 25% of it, or even 75% of it. You got to be realistic with your exit points here. The standard deviation lets you know where to enter at those outside prices where there might be opportunity, but don't be looking for a full reversal back to unchanged, because market's got to move somewhere here. And so I think that I always like keeping it simple here, which is I've got one measure, the standard deviation, Tony. I'm going to let that tell me where I get in and also where I get out.
Right. So let's break this down into two core components, right? You have the entry and then you have the exit. So let's cover the entry first. I think we've defined this. There's two stats that you need to know: the current price and the standard deviation. Once the net change of the day exceeds that standard deviation, so as you said, if the asset that's currently at $100 declines by, let's say, $6, which is outside of the $5 standard deviation, that is your opportunity. So in this particular case, because the asset declined by $6, we're going to go long the asset, or long the, whatever the asset is. And what you're going to do is you're going to, once you've entered the trade at, let's say in this particular case, $94, because that's $6 below 100, you're going to set in both a stop loss and a take profit that is equal to 1/2 of the standard deviation. So because the standard deviation is $5, you're going to take profits $2.50 above 94, or you're going to get stopped out $2.50 below 94. I just want to make sure that everyone understands those two concepts. If you understand the entry point, please type 3 into the chat window. If you also understand the exit point, please type 4 into the chat window. I just want to make sure everyone understands both the entry and the exit. Okay, I see a ton of 3s and 4s. Perfect. So as I've said, we kind of started off thinking that this is a very complicated strategy, statistics, math, but really when you break it down, it's actually a really, really simple strategy. And I think that this makes it really easy for us to go through a real example. Let's use the 10-year yield, which is your classic mean reverting strategy. And one of the best parts, in my opinion, of the small exchange is the fact that you guys have an interest rate product. And everywhere else, if you want to trade interest rates, and you've heard me on CNBC talk, hey, I think interest rates are going to go higher. I think it's going to go lower. And we end up trading all types of exotic products around that. We trade XLF, we trade KRE, things that are correlated to interest rates, but we're not trading the interest rate themselves. Sometimes we trade TLT or utilities or real estate, things that are, again, correlated with interest rates, but we're not trading the interest rate itself. But the small exchange actually has an interest rate product, meaning what you're trading is the actual interest rate itself, not a bond price, which is the inverse of interest rates, or something correlated to interest rates. You get to trade the interest rates themselves. And not only that, the small exchange publishes the standard deviations of all of their products. So if we look at S10Y, which is the 10-year yield small exchange futures product, as you can see, the one standard deviation move here is 57 cents, right? So that tells you what the current price of the asset, or in this particular in this particular case, the interest rate currently is. Where is the interest rate right now? What is the standard deviation move? And this tells you exactly, you look at the net change for the day. If it exceeds that 57 cents, there is your trading opportunity. So if it exceeds that 57 cents, you would either, if it's 57 cents higher than the open, then you would short the interest rate. If it's below 57 cents lower than the open, then you go long the interest rate. And you would set your stop losses at 1/2 of the standard deviation. So 1/2 of 57 cents is about 29 cents. And that's where you would be able to set your take profits and stop losses with a real example. So this is really just a simple, application of what we learned here before, Frank.
Yeah, absolutely right. And I see some of the questions coming in about, okay, so do I buy exactly down 57 cents? So in this case, let's say the market closes yesterday at $20. Do I immediately, when markets open today, do I put in my order at 1933 or whatever? I think I got that math right. But do I put in my order exactly there? Yeah, you can, but keep in mind, while these statistics are exact sciences, like the numbers are crunched, I can tell you completely above board because I crunch them myself here. While that's an exact science, it's not necessarily like a perfect exact science that, like, man, if I don't buy it down exactly 57 cents, then I have missed it. And that's the end of the road for me. I mean, I knew people who traded literally the 10-year US Treasury note, cash and futures and everything else here. And knowing these statistics, Tony, some people would stack the both sides of the book, starting at 1/2 a standard deviation all the way up to 2, and they would scale that position. So like maybe I'm selling one lot at 1/2 a standard deviation, 2 at 1 standard deviation, and then 5 at 2 standard deviations. I knew people who did it that way. I knew people who waited for 1.5 standard deviations to get in and then manage at 1/2 standard deviation take profit. Whatever you want here, these are the bare bones, the kind of like vanilla basic setup that I think is, as you're putting out there, Tony, is a great place to start. But as anybody knows, once you learn an interesting strategy like this and how it applies to options or futures or stock or what have you, then it becomes a little bit of a case of like, all right, what's my flavor on this? All right, if the standard deviation is 57 cents, then I'm going to wait for the market being up or down, 70 cents. Give it a little bit of room to breathe outside of that. Or I'm looking to get something on. I am a little bit inside of that standard deviation, and maybe I'll scale in with bigger orders nearer to a 2 standard deviation move. It doesn't always get there. Obviously, it's quite a rare move, but I have more size at those levels. But yeah, great basic setup here that lets how you can at least get started in a mean reversion strategy like this. Day trading, I mean, the 10-year, though this is a new product because it is priced in yield and it's a lot smaller for everybody out there. I mean, people have been trading mean reversion on 10-year Treasury notes, Tony, for decades. I mean, before I was born.
So, and there's some great questions, and I do want to come back to address them, especially around kind of when do you want to enter this trade? Can you make modifications to use 1.5 or 2 standard deviations? I want to address that here during the Q&A section. But the one thing I do want to address is that there are some questions about how do I get these stats, this standard deviations. That is something I'm also going to talk about here with Frank here in just a couple of minutes as to how you can get this for not only the S10Y, but all the products that the small exchange offers, this exact calculation, that standard deviation calculation. But I just want to make sure everyone understands the trade itself, the example that we talked about. So please type 5 into the chat window if this example I'm showing you here on the screen makes sense to you. Perfect. Okay, so let's talk a little bit about the small exchange, Frank, because you guys have the ethos of building small standard and simple futures contracts that is accessible to everyone. So if you don't mind just talking us through kind of this concept of building small standard and simple products and kind of what products you guys have and what products are coming out.
Yeah, absolutely. Don't want to spend too much time here because, as you, I'm sure, can agree with it. It seems like a lot of people interested in the strategy, and I want to get people the data and the strategy as much as we can here before time runs out. But yeah, the small exchange, we from the ground up have made it our mission to give people essentially greater access, easier access to all markets. So what we do, we went into interest rates and we made it, first of all, a smaller market. The ZN future, for instance, right now, over $100,000 in notional exposure. That's absurd. The E-mini S&P, even the micro S&P, thousands in terms of the E-mini, hundreds of thousands of dollars in notional exposure. That's absurd. We took all of the asset classes, whether it's interest rates, whether it's crude oil, whether it's equities, what have you, made it smaller, Tony, made them all look like each other. That's that standard piece. Everything, whether it's an interest rate that theoretically is a percentage point, we just looked at that S10Y priced at 23 bucks, that's 2.3%, but it ticks in pennies, the same that an equity product on our side does. And all of them tick in that penny, Tony, that equate to $1. So it looks and feels just like 100 shares of a stock that's priced at 23 bucks or what have you. And you can see here we've lent those ideas to equities, technology, and the small stocks there, being the two primary pieces. US dollar, which has been a really intriguing piece as Forex starts to move again. It's just a simple US dollar trade against euro and pounds and yen and everything else. And it looks just like an ETF or a stock or what have you. Same with metals, interest rates, crude oil, cannabis. And we are definitely getting deeper in the cryptocurrency field as well. Whether you're a crypto head or not, you can't disagree with the fact that those markets have seen some wild price action, Tony. A lot of data to crunch there, a lot of outside days, market coming back in. So we're excited to get some more cryptos out there just to apply the same strategies that people have been applying, like I say, to interest rates for decades. We're giving you even more products and making sure they're all small and they're standard and they're going to look and feel just like anything you'd be used to. So I don't want to go harp too much on it because honestly, the basic mission is like giving you access to crude and everything else in a product that you would be like, oh yeah, that makes sense. It ticks in pennies and that equates to $1 and they all have the same expiration. And it's none of this convolution of other futures products here.
Well, thank you so much for that background, because I do think it's important for those who are not familiar with futures just to understand what you guys provide. I do think that some of the products like the 10-year, the 30-year, the 2-year are some of the most innovative products that I've traded, and it's the ones that I've traded the most on the small exchange myself. So with that, let's wrap this up with some of the futures trading tips. And this is really coming from, a combination of rules that I've applied to not only trading futures myself, but also, borrowed from equities, if you will, and equity options. And, while following these rules by no means will guarantee any sense of success. But one thing I do, want to say is that by not following these rules, many times I can almost guarantee that you will not be able to succeed with trading. First of all, when it comes to futures trading, I spent years day trading futures. Having a simple set of rules to get in and out is really critical, because when you're day trading, discipline is really important. And the more complex your rules are, the less likely you're going to remain disciplined. And hopefully the set of rules that we showed you here today of when do you enter and when do you exit are a really simple set of rules that you can follow. Very few rules to involve. The fewer the rules, the better it is to follow. And really what we're using here is pure statistics to determine your entry and your exits. You're not using anything else necessarily. You're not necessarily using your charts. You're not using fundamental analysis. You just have to look at the pure statistics that generate those opportunities. But for me, from a risk management perspective, never risking more than 2% of your total account value on a single trade is really important. So many of you are working with smaller accounts. If you're working with that, the concept there is that if that if that half standard deviation move will stop you out and result in a loss that's greater than 2% of your total portfolio value, then you might want to think about resizing your trade or trading a different product. So if you get stopped out, that stop out should wipe out no more than 2% of your total account value. And generally speaking, never add more contracts to a losing position. So you've gotten to a position, it's not going in your direction, you don't take a loss, and you feel that the next day I'll add some more and hopefully get back to break even. Yes, that will work sometimes, and I've seen it work many times, but I've also seen those exact entries lead to some of the biggest blowups that I've seen in terms of clients that I've worked with. So that's just a quick set of rules that I have in mind. Frank, I don't know if you have any to add to that, from your trading toolbox, if you will, to just give people a bit of more tips in terms of trading.
No, just want to hammer home some of those last two, especially because you nailed it, which is like essentially never scale in unless you intended to scale in from the start. Because then you've taken your rules, your mechanics, and you've let emotions. There's like, oh man, this thing's going against me. Now I'm going to add more to it. Whereas, like I spoke to before, like if I had the idea, like I'm going to sell one at one standard deviation and two at two standard deviations because I'm comfortable with the risk, and that's the way that I'm setting up my rules, then go for it. But yeah, you don't want to be, oh, I'm short one, it's going against me. What if I throw on a couple more here? Then I could get back to scratch real quick. You don't want to be doing that in the moment. And that really just hammers home the whole mission here of your trading rules is like these mechanics, hopefully we've done a good job at simplifying them. So you have the stats, you have the math, and it's like, man, that stuff's actually not so complex. And it's because, yeah, it shouldn't be complex. It should be relatively simple rules that are stat driven, Tony, that I can quickly apply to dozens of products every day because I'm just looking for the handful that are outside. And you got to be able to peruse plenty of products to do that. And if your rules are too complex, you're going to get stuck just looking at 2 or 3 or 4 products. So I love all of this, man. This is perfect.
Well, thank you so much, Frank, for joining me this afternoon. Let's talk a little bit about if you are new to small exchange or new to small futures, how you can get started. First, you can open up a brokerage account either at Tastyworks or IBKR, the two main brokerage firms in terms of equity brokerage firms that offer these types of products, or there's a full list of futures brokers that you can trade these products at. If you are trading just at a regular futures broker, you can find that out at smallexchange.com/brokers, and make sure that you enable your futures trading in your account. So if you already have a Tasty or an IBKR account, make sure you enable futures, and that'll allow you to start trading these products. So I do want to ask users here, how many of you currently have a trading account with either Tastyworks or IBKR? Just to get a sense for the audience here. So almost half of you have an account with half of you have an account with Tastyworks, 15% of you have an account at IBKR. So the majority of you, almost 68% of you, have an account at either Tastyworks or IBKR, which means that you can just enable futures and start trading these products. The 40% of you that are answering no, you do not have an IBKR or future or Tastyworks brokerage account, you can open one up. OptionsPlay has an offer specifically for you at here, actually, whoops. This link here on your screen, trade.optionsplay.com/tastysmall. I will post this link into your chat window for those of you that would like to open up a brokerage account here at Tastyworks to enable futures for your trading. But it's important that you understand that you have to open a futures account. You have to enable futures in your account if you currently have a Tastyworks account in order to trade these products. And lastly, what I do want to talk a little bit about is some of the futures trading signals. So some of you have been asking us, for idea generation. We've recently just put out one this week on the crypto market. So this is where you can get access to futures trading signals from OptionsPlay completely free of charge at optionsplay.com/trade-futures. I will also post this link here into the screen for everyone to sign up. This is a free sign up sponsored by the Small Exchange. So we will be sending out our ideas from our research team with any of the commodity type products that Frank and I spoke about here today. You'll get exact entry and exit points. You'll also get updates to stop loss levels and take profit levels as they reach their levels as well. And sorry, lastly, this is the last one, the community membership. For those of you that are actively trading small futures, there's quite a few benefits, if you will, to the community membership. First, you get 50% off trading fees, so you get a discount on 15 cents per contract down to 7 cents a contract. But we were talking about the statistics of these products. That's really kind of what we're here to talk about here today. As part of the community membership, you will also get a weekly newsletter that has all of these all of the statistics of each product every single week. So I showed you the S10Y that has a standard deviation of 57 cents. Those numbers are crunched every single week by Frank himself. So you can get those updates as part of your community membership. So you get the 50% discount on the trading fees, you get the weekly newsletter, you have limited availability of some merchandise that they do give away for free. And this is all normally available for just $100, a single payment of $100. This is a lifetime community membership, but we are giving you a 50% discount to that membership. You can sign up at trade.optionsplay.com/small50off. So we're giving all of our members or our viewers $50 off of the lifetime membership here of just $50. That'll give you access to the discounted trading fees, the weekly newsletter for a single payment of $50. So with that, that covers what we wanted to share with you here today. At this point, what I want to do with Frank is try to answer some questions that you guys have had during the session and hopefully answer all of your questions before we wrap up here for today. So it looks like quite a few questions have already been answered during the session, and there's a few that are left here. So Frank, why don't you and I jump through these Q&A and try to answer as many questions as we have time for here today.
Love it, man.
What are all the mean reverting futures? That's a great question. And I think perhaps that's one that we can answer and type out so everyone can see these. For me, interest rates certainly are at the top of the book. Most of the commodities, gold, silver, crude, currencies also, are generally speaking, mean reverting. Look at where the euro is. Look at where the Aussie dollar is, and then look back 5 years, 10 years, 30 years. These are not currencies that shift a lot over time. They tend to trade around a long-term average. So those are the ones that at a high level that really jump out at me as mean reverting. Volatility tends to be mean reverting. I don't know if you have any more else on the top of your head.
You nailed from a broad view, Tony, the asset classes I would focus on, but I would also implore, here's a test for people at home that you can attribute to any chart that is in front of you, or it's like, oh man, do I think Apple stock is mean reverting? If you just pull up a long-term chart of a given market and see something like this, where a market is trading, in essentially like a sine wave or something like that, where it's oscillating kind of around a price, then it's most likely mean revert. Like your attribution to currencies, look at the long-term chart of the euro. It's been up a lot against the US dollar. It's now down closer to its lows, but it's never really broken out of a range of $1.05 up to 120, 130 in the last couple of years. And so you can kind of attribute this at home to any given market and almost test it for yourself. But yeah, absolutely. Interest rates, commodities, and currencies, definitely ripe areas for mean reversion.
There was a question regarding where do you find the standard deviation calculations? That is included in the weekly newsletter that's part of your community membership. So I posted a link into the chat window as to how you can get a discounted community membership, 50% off for viewers here today using that link.
But also, I don't mean to undermine something that I myself have kind of created. If you're not necessarily into that, an easy way to also get not a perfect number, but if you apply Bollinger Bands to your charting package, you'll get kind of like a wonky version of the standard deviation that's kind of hard to read, but it at least gives you a sense. If you're not, today wanting to commit to a full membership, here you can get a little bit of that flavor from Bollinger Bands. At the end of the day, though, of course, we want you to become members of the exchange for life. And it's one of those things. I didn't get a second to say it, but it's one of those offers that, like, it's good because our CFO actually he absolutely hates it, and that we're giving people lifetime reductions to fees and lifetime access to some of these data points for the one-time fee. So definitely get in, especially that OptionsPlay 50% off while you can, because it definitely gives our CFO a lot of consternation. So, but you can check out the Bollinger Bands if you're just looking for a quick calculation on something.
Thank you so much. There's one question here, which I think is a great question, is around timing, right? Meaning if you're getting close to the end of the day, right? It's 3:45, 3:55 p.m. and you haven't a signal to mean revert, how close to the close do you potentially enter one of these, or do you kind of throw one out if it kind of only triggers at the end of the day?
It's a gray area, Tony, that I'll give people two options here, and they can kind of decide for themselves. Because I honestly, this is one of the gray areas where depending on how confident I'm feeling, how outside of a move it is, sometimes I will put on that trade with less than an hour to go. And of course, I want to take it off by the close, but I'll be like, you know what? I'm going to hold this one through the night. Thankfully, with the small exchange, the products aren't so big. If I'm comfortable with holding it through the night, then I will, and look for a little bit of that reversion in the morning. Otherwise, if I'm not feeling it and I don't want to carry this through the overnight, Tony, I'm pretty much not looking to add new trades inside of 30, 45 minutes of the close there. And as we get closer to that close, I'll maybe tighten up my management mechanics. And so if the half standard deviation is 30 cents, let's say, and we're an hour or so to close, it's like, all right, I'll put this trade on, but I'm only looking for 15, 20 cents. And so once again, using those nice scientific numbers, but at the end of the day, you do have to feel out some of the stuff for yourself, depending on the opportunity and when it is. But you can use a rule of thumb of, like, if there's less than an hour or 45 minutes until the close, I'm probably not wanting to jump on this one.
Thank you. I appreciate that. And Joanne is asking a great question. Does this correlate with any technical analysis studies like Fibonacci levels? I will say that whenever you can combine multiple disciplines together, you can potentially add more conviction to a trade. So if, let's say, an asset exceeds its standard deviation, but at the same time is trading near a support level, that just adds conviction to the trade. And, that could just mean that you're more inclined to trade it, or you're more inclined to trade a slightly larger size than what you normally would trade. There's a few different ways that you can tackle that, but certainly if you can combine it with the other disciplines of analysis, that can, again, increase your conviction on the trade. There's a question about how do I calculate 1/2? I'm guessing the question is, how do you calculate 1/2, which is your stop loss level? It literally is just taking the standard deviation number and dividing it by 2. So when you take $5 and divide it by 2, you get $2.50. That's how you determine your stop loss and take profit levels. A lot of questions using, how do you calculate standard deviation? So again, it's part of the newsletter, or if you want, you can use Bollinger Bands as a potential way, or crude method, if you will, for doing so. I do think that the mathematical way of calculating standard deviations is more accurate, but you can do it using the charts and get a rough estimate using something like a Bollinger Band. A lot of questions regarding calculating standard deviations. Tom is asking the 2% rule. So Tom, the 2% rule does not mean that your stop loss is 2% below your entry price. It means that if you were stopped out on the trade, then the number of contracts that you've traded the loss that you have if you were to be stopped out should not exceed more than 2% of your total account value. So if you have a $10,000 account and you get stopped out on this trade, does that cause a loss that's greater than $200, which is 2% of your account? If the answer is yes, then that means you've traded too many contracts. If it's significantly less than 2%, then perhaps you can add more contracts to that trade. But the rule of thumb is that if you get stopped out based on the number of contracts that you've traded, it should equate to be no more than 2% of your account. So hopefully that clarifies that for you.
Yeah, and even a version of that rule that I apply that might be, a little bit simpler or easier to jump on board with is like the margin, like I was getting at for futures, is kind of around the standard deviation anyways. And so like if the margin if the margin on a position I'm about to take, Tony, is greater than 2 or 3% of my portfolio, then yeah, I'm probably not taking on that position. So that's another shorthand version to look at that. And just because I see it in front of me here, Sanjeev, I will jump right on your question in terms of ZT, ZN, and ZB. Those are the traditional futures, the notes, the treasury notes and bonds that coincide with S2Y, S10Y, and S30Y. And we actually update the ratios for those markets to each other in that member. It's also another statistic that's in the membership offer as well. But just from a shorthand here, it is about right now, this isn't an exact number, but right now the ratio of S2Ys to ZT is about 5 to 10 of those small 2-year yields to the ZT future. And then for S10Y and S30Y, it's actually a similar ratio between those yield products to the notes. And so what that's telling you there, Sanjeev, is that the small products are, a fifth to a tenth the size on a daily move basis, on a volatility adjusted basis to those ZT, ZN, and ZB products. And so hopefully that's a little consolation on the ratio question there.
Yeah, and just to add on to that, there's another question. Since treasuries are inverse to interest rates, can they be traded as a mean reverting asset? And the answer to that is absolutely. And arguably, it's the other way around. Interest rates are the inverse to treasuries. But yes, effectively, they are the same product. Just one is the output of the other in a different term. But yes, treasuries are mean reverting assets and can be used for trading that. Using your example of standard deviation of $5, then we are trading $500 in that trade example. So Joanne, yes, if you have a $100 asset and the standard deviation is $5, if that was a small exchange product, then yes, your assumption is correct, because the multiplier on all small exchange products is 100. Simple as think of it as trading 100 shares of an ETF. So yes, if it's a standard deviation of $5, you're talking about $500. But we're also talking about a stop loss of half of that. So your risk is actually $250, or roughly $250, if you were stopped out at the stop level. So in that particular case, if you're willing to risk $500 in a trade, then you can trade 2 contracts with a stop loss of $2.50, and you'll have a risk of roughly $500.
And what's nice is that we created all of our currently 10 products, Tony, to have a daily standard deviation. Of course, it fluctuates. Like right now, crude oil is moving around a ton, so you can't control for that. But at creation, almost all of our products were priced so that it would be like, all right, they all move around $100 per day. So all of them you'll see kind of range from 50 cents as a 1 standard deviation to $2 or $3 as a 1 standard deviation. Most of them centered around $1 being $100 notionally standard deviation. So yeah, none of them except for crude in its current state holding that big of a standard deviation move.
Right. Um, would you trade against the 210 inversion? So great question. Are the spreads between the treasury yields a mean reverting asset?
Oh yeah, like that's I'm glad I didn't want to go too deep today because and you and I have gone deep on this before, Tony, but that's actually like where a lot of this theory and a lot of this stuff comes from is we would apply at the board of trade these standard that the arbitrageurs and the proprietary traders, the pros at the board of trade would apply. There still are people there applying these mean reversion stats to those spreads. And I traded, yeah, the twos versus the tens versus the 30s. And so, yeah, absolutely that same concept holds. And right now you are seeing a huge extreme where 2 years are very close to 10 years. That spread has come in a ton. And yeah, I personally have on that, short 2 year, long 10 year, looking for that spread to normalize, to go away from inversion. Very apt, astute observation there, lending that same mean reversion quality that you've seen in VIX, that you saw today with outright futures, and applying it to spreads on futures as well, man.
Yeah. Well, with that, I think we've covered a pretty wide range of the questions and answered pretty much most of them here in the Q&A window. Frank, I just want to say thank you so much for taking your time out here this afternoon and joining us and walking us through what is a complex strategy into something that I think most investors here can appreciate and now can understand and have a new tool in your toolbox. Whether you're trading equities or futures, this is a strategy that you can now deploy across a varying amount of asset classes. So Frank, thank you so much for joining us this afternoon.
Thank you so much for having me, Tony. Always a blast to jump on with you. And everybody, thanks for hanging in through some of the maybe tougher math parts there. I hope everybody got a good understanding. If anybody needs anything, you can always reach out to me on Twitter at Frank_Kaberna, Kaberna, and I should be able to answer hopefully any lingering questions. But Tony, you're tops, man. Thanks for having me.
Thank you so much. And just remember, we will send out both the recording and the slides. We'll send you the links for all of these if you want to sign up for the membership, open up a Tastyworks account, or sign up for the futures trading signals research that we are now putting out here at OptionsPlay. We will send out the recordings, the links, the slides, everything to you as soon as tomorrow. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here tomorrow morning.